Welcome to the Twomey Stock Market Report. Today's Sunday, January 22nd, 2023, and welcome to the weekly update from the Twomey Stock Market newsletter. So first, you need to go to the number 2, mestocks.com, right up here, right? That's the website, the number 2, mestocks.com. And there you'll see right there on the front page, weekly newsletter. Click on that. It'll bring up the weekly newsletter, stock market report, and we've got quite a few things to talk about today. What I'm going to try to do is first outline pros and cons, okay? And then we're going to take it from there. That we're going to jump around a little bit in the report, but to give you an idea of what we sense that both fundamentals as well as technicals are telling us. So first of all, we're going to take a deeper dive right off the bat on the more of a longer trend, or I observe this as a longer trend analysis from a technical perspective. We look at the advanced decline of the New York Stock Exchange. Over time, what does that tell us? It gives us the trend, is it upward or downward? And it does take in a large amount of stocks, number one. Number two, it gives us a much more deeper trend analysis. And why do I say that? Because when you take a large basket, it tends to smooth out of information. It tends to smooth out the data, right? You got your highs and your lows. And with that said, I look at the advanced decline and what are we seeing right now? We've seen since the lows of the end of 2022, it advanced fairly steep and up. That's a great sign. More advances than decline. More stocks participating in the advances. In addition to that, it's crossed above the 50. And if you noticed here, for the end of 2022, that 50 EMA, I use exponential moving averages. It gives a little more weight to the most recent versus past. Most people use moving averages, and we'll talk about that a little bit more. But right now, if you notice, the 50 had acted as kind of a support resistance, and it was a very flat trade, if you will. We've accelerated above that. In addition to that, accelerated up the blue line, which is the 200 EMA. And if you look at that back here in August, when we had the last bear market rally, we did get above the 50. We got above the 200, stayed elevated for a little while, a couple of weeks, and then crashed down to new lows. So if you look at this trend, we're still below that high back in the last bear market. So therefore still that overall trend is downward, right? But are we going to stay above this 200 for an extended period of time and continue to grow? That's the big question. We look two things. This is the pro side. We say, okay, 61% of the stocks are trading in the New York Stock Exchange above their 200 moving average, not exponential. That we're talking moving average now, much more smoother averages. And last week it was 61.9. That's pretty good. I mean, the number was 81% mid-July, and then the recession of 2029, 100%, and those are below the 200 EMA. So 81% in mid-July were below the 200 EMA. So we've made a complete flip on that. Very positive, right? The con on that, the negative is if we look at the RSI, it's way above. It's up in 69. And, we had what is that telling us? That's overbought territory. The last time the RSI was up in those levels was 72 back in the bear market rally in August. And what transpired, it told us it was overbought. And sure enough, and we retreated down to new lows. So that tells us, yes, the market has more stocks participating. They are advancing more than declining. We have a breadth improvement because we're 61% of those are now above the 200 EMA, a dramatic change from what we saw in the last part, most of last year, except for the August bear market rally. We're concerned because the RSI is so elevated. The MACD down here is very strong, very positive divergent, and it is in a very strong upward slope. And it takes a lot of momentum for that to get up into that territory. And we still aren't up into the heights of where we were in the bear market rally. So more to come on that. So that's kind of another positive. And we're going to go back to, we use the SPY as a kind of overall trend. And you'll see this in the market report. It will go into this a little bit more detail. But we look at what's the gross picture of what's happening. We use the SPY to look at in the past 12 months. And sure enough, you can see downtrend is still in place. Every time prices get into this upper trend line, what happens? We abate and we hit a new low. And then we go back and try it again, and we came back and hit new lows. Well, we did try to get up there in December and the end of November, and we started retreating. The difference here is we have not, on that retreat, it did not make a new low. We kind of came up on a higher low. This week, we hit this upper trend line once again. It got repelled, and it happened to be the 200 EMA for the SPY, and we had a fairly quick sell-off. So it's still, that upper trend line is tough to break, but what's positive, it is staying above the 50 EMA. Here's the SPY daily chart. This red line we talked about, advanced decline. This is the 50 exponential moving average. You did manage this week to stay above that, even though we broke briefly below that. We are staying above the 9, 14, and 20 EMAs. Those are all our short-term indicators. And, the question is yes, we bumped up to the 200 for the third time and got repelled. We need to break above that to see that more strength. The MACD is very positive. The green is above the red since, the beginning almost of the year. It crossed positive. It's staying positive. That's a very strong indication, because it's a slower momentum indicator that the market is moving forward or upward, or prices are improving. It takes a lot of energy to get that above zero. If it can stay up there, that means better prices, or at least sideways to come. The stochastics down here at the bottom, the green drip, obviously the sell-off this week. Green came below the red. This is a short-term oscillator. Tells us the immediate trend at this particular moment in time, and it does oscillate very fast. We don't trade off of that. But when we see it get above 50 to 75 range, we know a trend is changing. Well, this week it only dropped down to 49, and then it raced back up, and it's closed at 80. So that's telling us that it's a positive bias. What else? The NASDAQ. Yes. What has happened? Year to date is the Dow Jones is only up 0.7%, S&P 3.5, the NASDAQ 6.4, Russell 6.2. So what are we seeing? The Dow had been the stronger index all of last year of the four. Everything else we're in bear market territory. We opened up the year, and now this year we're starting to get some gains. And where are the gains occurring? Much more in the riskier sectors, and we're kind of getting a little bit of a sell-off in the Dow. So money is rotating into these riskier trades, the NASDAQ and Russell. That's kind of a good sign, because people feel that when institution, fund managers, hedge funds, technical traders are looking at the beaten up tech stocks, the small caps are bargains, and they're feeling that they're at lows that they can't resist. We'll see. I mean, it's early yet. What else? We're looking at I'm going to bounce around here and keep it, so bear with me on the screen. I want to show you this as well. Typically we go through a much more, top to bottom on the market report, but you'll see the sector table. The 1 month trend, everything's in green again. Now we saw that part of December, and what happened? The next week, 80% dropped into the red. So, really, it has been a tough market for that, to say the 1 month trend is going to be a long-term predictor. We look at the 6 months, and of course, year to date over here, I mean, that's since January, so it really doesn't tell us much. But the 6 month trend, if we look, materials, XLB, that we're in has been positive and, the leader. Financials, we had JP Morgan. We got stopped out of that, unfortunately, this week in the Goldman Sachs debacle, but we may come back to that. Some might have held because it just barely hit our all sell signal, but for a positive gain, but we may get back to that one. I did buy back into it, but I didn't send an alert. Energy, of course, and then, industrials, XLI, which got hit on some of our stops this week. So that, still remains the play. The 1 month, communication, consumer, of course, is defensive. Materials and financials are starting to abate, as we talked. We still hold REITs and real estate. We still hold energy. They're faring pretty well for the 1 month. Okay, so that's what's going on there. All right, so what's the another con? The RSI table. RSI is telling us a couple of things. SPY and Dow are in the low 60s. The Nasdaq it hasn't hit the 60 yet. The Russell's mid 60s. That's the first one that's heading towards an overbought. That's an alarm right there. But the others have room to advance, and the turnaround Friday helped a lot, and we still have lower RSIs. So, once we get into the mid to high 60s, most people say 70s the overbought. We start paying attention to the mid 60s and tighten our stops. And then, of course, when you get to the high 60s, we're technically overbought. If you look on the short side, the SPY and the DOG or the diamonds and the Dow and the PSQ, they're all, 40 to high 30s. Oversold, we start getting the mid 30s. What does that tell us? Yeah, there's a little bit more room to grow, but at some point people are going to say, so we've got to see where this week brings us. If we start getting a higher elevation for RSI on the SPY, Dow, Nasdaq, and of course the Russell, then we know the market's getting tired, right? So that's what the advanced decline's telling us. We really have to look at those technical technical information to tell us where the market is going, right? So overall, what's happening in the market? We've got some certain sentiments that we're concerned about. Manufacturing, the PMI, Production Manufacturing Index, the services in the ISM index are both below 50. The PMI for 2 months has been below 50. Well, on January 18th, production of the U.S. factories fell more than expected in December. The output in the prior month was weaker than previously thought, so they revised even the previous month further down. So the manufacturing output dropped 1.3%. The Federal Reserve said on Wednesday, came out with that on Wednesday. The data for November was revised lower, decreasing it by 1.1% instead of the 0.6. So that is telling us a couple of things. With the decline, that is recessionary indicators, because we've said this before. If manufacturing and service sector is declining, they're not going to build more inventory to hold it in the warehouse. They're not going to buy more raw materials to make the product to leave it in the warehouse, and then they'll start ultimately. So that demand goes down. So that interest rates are working. Number two, they're going to start laying people off, because if they're not producing, you're not going to pay them. And those sectors, the manufacturing and the service sector, they don't fool around. They get rid of people real quick, right? So we're going to, if that starts showing layoffs, that in addition to the high-tech layoffs that we're getting, it's going to be a serious blow to the markets, and we're going to see a very serious decline. So we have to be concerned about that. The other thing we talked about over and over again is this lag factor. I mean, we're really just starting to feel the rate increases from June and July, and of those 0.75 increases back then. If you look at July, it was only the Fed funds rate was only 2.25, 2.5. And if we're just feeling that effect now, we've got to get through all the way up to 4.5%, which was the December rate increase. Add on February's, which would be 0.25 or so. So we've got another, 2.5% of rate increases that the economy hasn't even felt yet. That's going to really slow demand. So those are the things we have to be concerned about. Our four tenets of the recession, that still has held, which is a good sign. I'm going to, again, jump around here a little bit. The tenets of the recession is telling us simply this. What we have is a decrease in the PMI and ISM, correct? We also have a decrease in GDP 2 months negative, but then it rebounded and that was positive, so that negated that one. And then layoffs. Unemployment still remains very, very strong. So that tells us, as long as employment stays and GDP stays positive, we've only got, 2 of the 4 recession indicators are positive, then that's pretty good, right? The inverted yield curve, that's happened most of 22. It's still going on now. That's bearish. So in theory, 2 of our 4 are negative and 2 of the 4 are positive. So we're at neutral territory. And what is the market doing? Some days it buys, sometimes it sells off. The sense that I'm getting is that the quantitative traders, the technical traders, the day traders, the hedge fund managers, they're using the 250 EMAs or moving averages as areas for buying and selling. And what does that cause? It's causing, this erratic buying and selling. You add to that every time we bump up against the, this upper trend line, especially for the SPY, it brings in more sellers. Add to that everything on the news is, are we going to have a recession or a soft landing? Pretty much the Fed pivot is off the table. We've been saying that for quite some time, but I'm not hearing that much in industry. Oil is starting to increase. There's quite a bit of information. We talk about the oil sector here in our market report. So that is going to push more pressure towards the recessionary trend. Right now, we're leaning more towards the bullish side. And our positions we've taken include a lot of dividend plays, and we're not holding very long. If we see trouble or we hit, our first indicators for sell, we get out because we don't want to participate if we have a dramatic sell-off where you lose 4, 5, 6% overnight or the next, quickly in a day or two, as we saw this week. So where are we? Well, we're still long the TLT and the 200% version of that UBT. That's basically the 20-year Treasury bond. We feel yields are stabilized. Even though with the Fed's raising rates, and that's going to be in February, our yield's going to start marching upward. The fact that they're staying level and have come down tells us that they're forward-looking. That's saying the market is saying, the economy is slowing down, demand slowing down. We don't feel that companies or bond issuance are going to have to really show, higher yields to get people to buy them. People are still going into the bonds for safety. So we're going to stay there, even though it is getting close to our first sell signal, and it did drop this week. All right. We also, the indices with the small cap, we got, Tale of Two Cities, our first stop hit for a small gain, and then it raced back up, and we're up 2.25%. The NASDAQ still staying strong, and we're only up 2% there, even though the NASDAQ for the whole year is up 6%. So we're going to try to hang in there as long as we can. The indice trades are buy and sell signals. We don't buy at the bottom. We don't sell at the top. We're looking for that longer trend. If it's not there, we get out. We can always come back and fight another day. Stock ETFs, Verizon, we sold off. That's one that once it hits its negative down trend, it sells off very quickly. So we even though we took a loss, we got out of that. That last stop is not active. The Goodyear tire, we got out with a basically 0%, 0.18 on half, and then minus 0.6 on the other. We may return to that, and that did rebound on Monday, on Friday, back up to 11.4. So we may get back into that. Our capital management, sort of a real estate type investments, got a 15.9% dividend, and that's holding at 3.18. MGM, that's holding at 3%. That sector is still pretty hot. The XLI, the industrial, we're holding a small half. Our last position there, the first half got stopped out for a small or neutral gain, and then we're holding that as a negative. As we said, the Dow is nearing its sell signal. If it does, the XLI will as well hit a sell signal. So we're on watch for that one. That's the whole pro and con. Even though the NASDAQ money's going into the NASDAQ and small caps, it's rotating out of the Dow. Maybe there was an excess of people in the Dow, but the Dow was still negative for last year, right? So why wouldn't you leave some money there and take your cash and move it over there? So it's interesting, and we're going to have to see how it plays out. The iShares EFA, which is Latin America fund, mostly of raw materials, that's up 2.9. Borg Warner, we hung in there, that's up 5.2. That's not a big mover, so that's a nice gain in a short period of time. We're still in the energy sector, XLE. It's too bad we get stopped out of XOM. That keeps coming back. XLB, the materials, we're still in that 2.5%, but we did get the first half sell-off for 0.2% gain. Again, that this week we saw a lot of a rapid downturn, and of course ETFs got hit as well as individual stocks. They were out of the gold miners. We don't play around on that one. That can drop very quickly. Our other dividend play, the Plains All American Pipeline, natural gas, oil, mostly in North America, that's up 2.1. That's dropped off quite a bit, but it's a dividend play of 7%. The also Crescent Point Energy, which is a low price stock, and we're very careful on that. We got in late, alerted subscribers late last week, and we got it, and that's already up 4.1%. That does fluctuate. We have to be careful. Obviously, low price stock. XLU utilities once again got stopped out. That should be moving forward if the markets moves forward. Less need to be in utilities because they tend to be a safe haven and dividend play. If people feel that utilities are not going to offer enough return, they'll jump into the things like the NASDAQ, small cap. So it's sort of a positive sign, but we did get stopped out of that. JP Morgan, also we sold for a 1.4%. I left this here as the price, as you can tell, it has come back a little bit, but we are 118. Yep. Okay. Right before Friday rebound. We got out of all that. I was just trying to read the date there. Mutual funds, we're still holding the S&P, the NASDAQ, and small cap. They're slightly better than they were last week, or fairly neutral, if you will. So we're going to hang with those for a while and see where that goes. So overall, we've got a lot developing. There's a lot of pros and cons here, but do me a favor. Go to the website. Take a look at the TwomeyStocks.com, the number 2 MEstocks.com. Pull up that newsletter. Right here's the tab. Take a look at it, dissect it, make some notes. Things that you could start trading are in there. And then also it gives you an idea of these technical indicators that we're concerned about. The elevation towards the RSI, the elevation of the RSI and advanced decline. We're really concerned about those. If they start showing further stress, then the market's ready for another leg down. Right now, we're holding our longs. We've got tight stops. You can also sign up and get our trade tracker, right? Then that part of that, you get your stock alerts real time. the buys and sells signals, and it comes right to your desktop email. In addition to that, you'll get all our training videos, which helps you decide on how to, where you should enter the market. Stops, buys, trends, identifying areas or sectors that you should be investing in. So I'm James Twomey. This is the Twomey Stock Market Report, and that's the weekly market report. Go to the website, take a look at it, and happy trading. We'll get some more information out later this week. Thank you.